Pepsi, what is up with your cash flow? I took the opportunity to take a deeper dive into Pepsi's cash flow, and what I found was a bit alarming. If you want to see the results of this analysis, stay tuned. Hey guys, Kevin Burgess back again with another video. I had joined a live video chat with my buddy Russ from Dapper Dividends, and he brought up this issue with Pepsi's cash flow. I want to shout out to my buddy Russ. Thank you for the question. And this is a great opportunity of how the dividend growth investing community kind of works together. It's a neat group of people who are studying stocks, who are trying to learn more and grow in the way we manage our investing portfolios and understand businesses. So, this is a great example of us working together and trying to figure out, where should we put our money? And to be honest, that's why I started a YouTube channel on dividend growth investing, is because of this community. I wanted to share at least what my journey is as I walk through this dividend growth investing. And I wanted to do that along with others so that we could grow together. And so if you're not a subscriber to the channel, I would love it if you would subscribe. It would mean the world to me. So I did a bit of an analysis on the Pepsi's cash flow. I'm going to apologize up front. There's a bit of spreadsheet work here, so there's some nerdiness that's happening, but I wanted to share that with you. And without further ado, let's get started. Okay, just a little bit of background on Pepsi. I mean, pretty much everybody knows about Pepsi. It says soft drinks here. This is Simply Safe Dividends. It says soft drinks, but they are much more than a soft drink company. In addition to soft drinks, they have a myriad of brands that they sell, like Lay's potato chips and Tostitos, Cheetos, Doritos, Ruffles, Fritos. So if you look at all these drinks as well, Gatorade, Pepsi, Mountain Dew. So just a myriad of name brands. And because of this brand recognition, they earn, in my opinion, a wide moat. So with that being said, let's take a look at some of the information on Pepsi. They have a Simply Safe dividend rating of 93. That's actually really good. Their dividend yield is about 2.88%, and their last dividend growth was a 10% dividend growth in February of 23. That's one of the things that we'll be questioning as we move forward here. So looking at the last 5 years, they've got a 7% 5-year CAGR in dividend raises. So, I mean, this line is what we're looking for from a dividend growth perspective. They have a dividend growth streak of 50 years and a dividend streak, an uninterrupted dividend streak of 58 years. So when we take a look at some of the metrics, so look at this earnings payout ratio, it's actually a bit high. I mean, we typically, at least what I look for is anything with a 60% or lower. And Pepsi happens to be in the high 60s to low 70s for the last 5 years. Let's look at their earnings per share. It is basically up and to the right. Their shares outstanding has come down a bit. It's not much over the last 2 or 3 years, but they have come down some. They have some buybacks. Their revenues are growing pretty quickly. They have a 19% return on invested capital, which is really nice. They do have a pretty high net debt to capital, which is about 68% of their capital structure is debt, which means 32% is equity. And their interest coverage is about 15.71. So this is really good. Anything above 8, I think is pretty decent. But what we didn't look at, and the thing that is a bit alarming to me, is let's go back up and look at their cash flow. So when you look at the free cash flow, especially since 2018, you see a payout ratio. So that means that the dividend paid out has been 83% of the free cash flow, 98%, 87%, 84%, and even last year at 111%, which means that they paid out more in their dividend than they actually had free cash flow. That's a bit alarming. Let's look at what Morningstar says about them. They have a wide moat. Their fair value is around 170 according to Morningstar, and their capital allocation is exemplary. So guys, here's where we get a little bit nerdy. So we're going to look at this free cash flow in more detail. I downloaded Pepsi's cash flow statements for the last 10 years, put them in an Excel spreadsheet. I'm not going to go through all of these numbers, but I will point out some things that I noticed. And I've got this here on the screen so that you can see it. And I've color coded a few things, but let me talk through what this is. Line 76 here shows their free cash flow per year. And then line 77 shows the dividends paid. This is the free cash flow payout ratio that's calculated based on the data that I downloaded. So this is the free cash flow payout ratio. You can see back 2013 through 2017, the free cash flow payout ratio was somewhere between the 50 and 65% range. That's not too terribly bad, but you can see in 2018, it jumped to 80%, 98% in 19, 86, 83, and now 110%. And again, this is just the dividend payout compared to the free cash flow. If I also then look at the stock buybacks that they've done, as you can imagine, it differs by year in terms of percentage. So, last year, 2021, it was only 1.5%. This year, 2022, it jumped back up to 26.8%. So the point of this is they have dividends that are paid. They have stocks that have been bought back, and we consider that payments to the shareholder. So when I add both of these together, I get a total percentage of free cash flow returned to shareholders that's pretty large. I mean, look at this. Even back in 2014, it was 114%, 116% in 2015, 113% in 18, 153% in 2019. So I won't go through all of these, but you can see even in 2022, 137%. So how does Pepsi survive having payout ratios of cash greater than the cash that they're bringing in? So let me define what this line is here, line 87. Line 87 I've called net operating cash reserved for growth. And what that basically means is if you have free cash flow and you pay your shareholders a dividend and then you buy back some shares, whatever money is left over, you are reserving as a company to grow your business. So for instance, in 2014, they're paying out more in dividends and stock buybacks than they had cash flow. That means that they are robbing from the business the amount of money it takes to cover that dividend and stock buyback. And in this particular case, it was $1.1 billion. And you can see also in 2022, they robbed from the business $2.1 billion to pay back to shareholders. So let's move on here. The next item is debt issuance. So one of the things about cash flow is you can either issue debt or repay debt, and you can see that in any particular year, they've done one or the other. Especially, I'll point your attention to 2015 to 2017, as well as 2020. And you can see that they had issued debt in 4 of those years, significantly in 2020 with $11.3 billion. In 2022, they sold a joint venture and actually brought in cash of about $3.5 billion. So to kind of boil this all down, Pepsi returned to investors $2.1 billion in 2022, more than its free cash flow. How did they finance that? They financed that through this sale of this joint venture. But that's a one-time thing. I don't want to depend on them selling their investments and selling their assets every year to cover the dividend and the stock buybacks. That doesn't seem like a lasting model to me. So let's look back at 2020. They paid $1.1 billion more to shareholders than they had free cash flow. They financed that by issuing $11.3 billion in debt. They are consistently paying shareholders more than their free cash flow. And so what I thought I would do then is add up the 10 years. And you can see that over the last 10 years, Pepsi has paid about $7 billion more to investors through dividends and stock buybacks than it has free cash flow. So the sale of this joint venture in 2022 sure helped their metrics in terms of cash flow, but I am concerned about them continually giving out more to shareholders than their free cash flow. I mean, technically, we would want the business to be generating free cash flow, paying some of that to shareholders, using some to grow the business, using some to pay down debt. I mean, in the short term, it might feel good to get more from the company than its free cash flow. But in the long term, I don't believe that's a sustainable model. I mean, what Pepsi has going for it is that they have a solid product line. They have incredible brand recognition. They have some great, solid margins. The demand for their snacks and beverages tends to remain resilient through even downturns in economic cycles. So they have significant economic moat, in my opinion. So if they've got good margins and they've got a big moat, they can get themselves out of this. But it is important as investors for us to recognize that Pepsi has historically, over the last 10 years, struggled to generate enough free cash flow to pay for the dividends as well as the stock buybacks. So in the comments below, let me know what you think about this free cash flow issue with Pepsi. Is this real? Is this something for us to be concerned about? Are you concerned about it? Does this matter to you? Is this something that, let's have a conversation around this free cash flow at Pepsi. I would really appreciate that. So what does that mean for me? What am I going to do with Pepsi in my portfolio? I think I'm going to hold the Pepsi shares that I have. It's only about 1.4% of my portfolio, so I'm not overexposed. I do like having Pepsi shares in the portfolio, so I'm going to go ahead and hold on to the 1.4% of the portfolio in Pepsi. Now, Pepsi is perennially overvalued, in my opinion. I was able to buy it on a dip, and now I'm up about 17% on it. So I'm doing well in my Pepsi investment. So if you like this kind of video, you're into dividend investing, consider giving me a thumbs up on this video. It would mean the world to me. It lets others know that the content inside this video is good. And also, if you want to subscribe, I'd love to have you along for the journey. And with that, I will see you on the next video.